Welcome back to the deep dive. I want to start today by asking you to think about, basically every business news headline you've read for the last decade or so.
Yeah, it's definitely been a one-note song for a while.
Right. Because if you're like me, you probably feel like you've been trapped in this loop. It's always the same story. What is the central bank doing? When are they cutting rates?
It was the only game in town. I mean, every developer, every investor, every corporate strategist was just obsessively watching the ticker, waiting for rates to move down by a quarter of a point.
Exactly. We've been trained to believe that the cost of money is the only dial that matters. If rates go down, business booms. If rates go up, everything freezes.
But we have a stack of research here today that basically says, stop looking at the rates.
Which is a pretty bold claim to make right out of the gate.
It really is. But the core argument we're looking at is that the era of interest rate dominance is actually over. We are moving into a new phase where the thing that determines whether a company grows or whether an office building actually makes money isn't the cost of capital at all.
It's the cost of living, specifically housing.
Right. This is the pivot to housing affordability as a systemic constraint. And to be clear right up front, we aren't talking about housing purely as a social issue today. Obviously, it is like a massive social issue.
Of course.
But for the purposes of this analysis, we are talking about housing as a hard, physical cap on the Canadian economy.
So the source for our deep dive today is a fascinating white paper. It's titled Housing Affordability as the Defining Constraint on Canadian Commercial Real Estate Development. And it's authored by Forbes Rutherford.
Yeah, and what makes this so interesting is that Rutherford isn't your typical real estate analyst.
No, not at all. He's the founder of Rutherford International, so his background is actually in executive search and talent strategy.
Exactly. He's usually the guy trying to find a CEO or a highly specialized engineer for a major firm. So when he looks at commercial real estate, he's not just looking at bricks and mortar or yield spreads. He's asking a much more fundamental question.
Where are the humans?
Right. Where are the humans? Because you can have 0% interest rates, but if your workforce cannot physically or financially exist within a reasonable commute of your building, you literally have no tenants.
If they can't afford to live there, the office is worthless.
That's the entire thesis, and it flips the traditional real estate model on its head.
So let's unpack this. Our mission today is to figure out why alpha generation is no longer about predicting a 25 basis point rate cut, but about finding geographies where the workforce can actually afford to live. We're going to look at three big ideas. First, the exit fee phenomenon.
Which sounds like a tax, but it's not.
Right. It's actually something much scarier for recruiters.
Mm.
Second, we'll dive into the pricing paradox, why real estate in places like Toronto is behaving in a way that just defies basic Econ 101.
That part is wild.
It is. And third, we'll look at the trigger scenarios. Basically, what happens to this whole fragile system if something like USMCA 2.0 or massive trade tariffs kick in while we're dealing with this housing crisis?
The pricing paradox is probably the most revealing because it suggests the market is already pricing in a failure by governments to fix these problems.
We'll definitely get into the math on that in a minute. But first, we need to define the sheer scale of the problem. The paper talks about this affordability ceiling. And I think a lot of people just assume that if the Bank of Canada cuts rates to, say, 2.5%, the good times just automatically roll again. Why is that assumption wrong?
It's wrong because of what the data calls the core housing need. The projection is that by 2027, we're going to see 2.6 million households in Canada in core housing need.
Let's clarify that term for a second. When we say core housing need, a lot of people might immediately picture homelessness.
Yeah, and that's a very common misconception. Core housing needs certainly includes people in extreme distress, but it also includes people who are just spending way too much of their income on shelter. We're talking 50% or more. Or they are living in places that are completely unsuitable, like overcrowded apartments or places needing major repairs.
So we are talking about employed people.
Fully employed people. These are your junior accountants, your nurses, your logistics managers, tech workers. If 2.6 million households are in that state, they have zero mobility. They are financially paralyzed.
They're just treading water.
Barely. So if a company wants to expand their operations in Toronto or Vancouver, they need to hire, right? But the talent pool is effectively capped. Nobody new can afford to move into the metro area, and the people who are already there are struggling just to stay.
Which connects directly to that exit fee concept you mentioned earlier.
Mm-hmm.
When I first read that heading in the source material, I genuinely thought it meant a government penalty. Like you pay a literal fee to leave a province.
It definitely feels like a penalty when you look at the numbers, but it's purely market-driven. Think about it this way. Let's say you own a nice average home in Moncton, or maybe Saskatoon. You've got a pretty good life, a totally manageable mortgage.
Right.
Then you get a job offer in Toronto, and it comes with a 20% raise. Sounds great.
On
Then
paper, absolutely, you take that deal.
But then you actually look at the housing market in Toronto. To buy a comparable home or even a downgrade, you'd have to take on a mortgage that is double or triple what you have now. That massive financial gap, the sheer cost of upgrading from a Tier 2 to a Tier 1 city, that is the exit fee.
It's the cost of exiting your current life just to participate in the hub economy.
Exactly. So that 20% raise, it evaporates entirely.
It's worse than evaporates. You actually end up poorer at the end of the month.
You do. So rational, ambitious people are looking at these offers and just saying no. And that is a huge historical shift. Historically, human beings moved to where the jobs were. Now the housing spread is so wide that it traps talent in place.
But is this entirely just about house prices? Or is there more friction built into the Canadian system?
It's not just real estate prices. The paper highlights a massive credential barrier that makes this whole situation even stickier. Canada has this bizarre problem where we have interprovincial trade barriers for human beings.
You mean like how a specialized welder in Alberta can't just easily go work in Ontario?
Right. Or a nurse, or an architect. The licensing redundancies and credential gaps across provinces create a massive headache. The source material estimates that these interprovincial barriers actually reduce worker mobility by 7 to 12%.
That is a massive drag on the national economy.
It's huge. It means our labor market isn't fluid at all, it's sludgy. And when you combine that regulatory sludge with the financial exit fee of housing costs, you get a labor market that simply cannot respond to corporate demand.
Okay, so that's the Canadian context. But the paper makes a really strong point of contrasting this with the United States. It basically calls it a tale of two markets. Is the U.S. not dealing with this same exit fee dynamic?
Nowhere near the same extent. The key word the report uses to describe the U.S. market is elasticity.
Meaning the market can stretch and adapt without breaking.
Precisely. In the U.S., labor mobility is incredibly high. If a state gets too expensive or if taxes get too high, people just pack up and leave. If another state creates a bunch of jobs, people arrive. It's highly fluid. Look at Texas.
The paper specifically models Austin versus Toronto, right?
It's the perfect comparison. Austin has seen unbelievable growth. But they also have what the report calls aggressive mobility. The rental mobility rate down there is around 54%.
Wow.
People move there, they rent, they switch jobs, they buy a place, they sell it. The market just churns continuously.
And they build?
They build relentlessly. And because they have things like right-to-work laws and no state income tax, the friction to move is incredibly low. The operating mantra in the U.S. is, if you build it, people can and will move there.
Whereas in Canada, the mantra is becoming, if you build it, they can't afford to come.
Exactly. The demand in the U.S. is driven by capital flows and business cycles. But Canadian demand is gated by the physical and financial accessibility for the actual humans.
Which brings us to the part of the white paper that I found the most counterintuitive. The pricing paradox.
This is where we really get into the weeds of investment strategy.
Okay, so walk me through the normal logic first, this basic theory. If I'm a commercial real estate investor and central bank interest rates fall, property value should go up, right?
Generally, yes. If borrowing costs drop, investors are willing to accept a lower yield, which we call a cap rate on a property, which naturally bids up the underlying price of the asset.
But the report says that is not happening in Toronto.
No, it's not. And this is the paradox. Toronto actually has lower base interest rates than the U.S. right now. The Bank of Canada has provided more rate relief than the Fed. So logically, Toronto real estate should be booming. Values should be soaring.
But look at the cap rates.
Exactly. They are sticky. They're hovering around 5.92% for major office and industrial assets. They just aren't compressing.
Meaning investors are demanding a higher return to put their money into Toronto compared to other markets.
Yes. They aren't willing to pay a premium.
But why? If the money is cheaper to borrow, why aren't they buying up the properties?
Because they're pricing in a growth discount. Sophisticated investors, we're talking pension funds, institutional capital, they are looking at Toronto and saying, okay, the financing is cheap, but can the corporate tenant inside this building actually grow their business?
And the answer is no.
The answer is not easily. If the tenant can't recruit talent because of the housing crisis, they can't expand. If they can't expand their headcount, they don't need more space, so rents won't rise. If rents don't rise, the building itself isn't worth as much in the long run.
That makes total sense. They see the labor constraint.
They see it clearly. They are discounting the value of Canadian assets because they know the human capital is trapped.
Compare that back to Austin.
Austin has higher interest rates right now. The Fed funds rate is higher. But investors down there are happily accepting tighter yields, lower returns on the real estate itself.
That seems entirely backwards. Why accept a lower return in a high-rate environment?
Because the growth story is intact. They know that in Austin, companies can hire freely. A tech firm can say we need 500 new engineers, and people can physically move to Austin tomorrow to take those jobs. So investors bet heavily on future rent growth. In Toronto, making that bet is just too risky.
So the pricing paradox is basically the global market telling us that labor mobility actually matters more than interest rates.
100%. The paper actually includes a really fascinating sensitivity analysis on this. It models out what would happen to commercial real estate if Canada actually fixed its labor mobility issues.
That was the outcome.
If we just made it easier for people to move, if we removed those interprovincial credential barriers and lowered the housing friction, Toronto cap rates could compress by 15 to 30 basis points.
Now, to a layperson, 15 to 30 basis points sounds incredibly small.
In the commercial real estate world, that is massive. That represents billions of dollars in value creation just by letting people work where they want to work. But without that reform, we are stuck in this affordability trap, and yields stay sticky.
I want to shift gears to the other major constraint mentioned in the paper. We've talked a lot about housing supply, but the paper argues you can't just solve housing with zoning changes alone. You hear this all the time on the news. Just legalize fourplexes, build the missing middle.
It's the most popular political slogan right now, but the paper pushes back hard on that. It calls infrastructure the hard cap. You can rezone a whole neighborhood for high-rises tomorrow, but if the sewer pipe under the street is only 6 inches wide and the electrical grid is maxed out, you aren't building a single thing.
It's interesting that you mentioned the grid, because the report pivots pretty aggressively here to discuss power. Why is a paper about housing and talent talking so much about electricity?
Because power has become the invisible wall for the entire economy, specifically for industrial and commercial growth. Think about what is driving real estate demand right now globally.
Data centers, AI.
An unbelievable amount of demand from AI. Global power demand for these centers is expected to double by 2050. So now, when a major company looks for a site, whether it's for an advanced manufacturing factory or a server farm, the first question they ask the broker isn't how much is the land, it's can I get 10 megawatts of power?
It's becoming the primary filter for site selection.
It absolutely is. The report notes a wild statistic. Industrial sites that have pre-allocated power, meaning the grid connection is already approved by the utility, are trading at a 15% premium over standard logistics land.
You're effectively buying the electrons, not the dirt.
Exactly. And this ties right back to housing, too. Because if you build a massive new cluster of condo towers to solve the housing crisis, that also puts an immense strain on the local grid.
And on transit.
Yes, transit is the other half of the infrastructure hard cap. The paper makes a key point about the radius of density. You can only build highly dense housing within a certain physical distance of high-capacity transit. If you build it further out, the commute becomes completely impossible, quality of life degrades, and political resistance from the locals just stops the development.
Is that transit constraint reflected in asset prices?
Absolutely. The paper shows that commercial assets located within a 5-minute walk of major transit hubs are trading at 20 to 30% premiums. That is a huge spread. It basically tells you that the old real estate adage of location, location, location has really become transit, power, transit.
Okay, let's look forward, because we're sitting here analyzing this in 2026. The paper outlines what it calls trigger scenarios for the next 12 to 24 months. These aren't firm predictions so much as if this, then that models. Let's start with the optimistic view, the bull case.
The bull case essentially relies on political competency. It assumes the government actually implements the Free Trade and Labor Mobility in Canada Act.
Which is quite a mouthful.
It is, but it's basically a legislative hammer that would tear down all those internal borders we talked about. If that happens, the IMF actually estimates it could boost Canada's overall GDP by about 7%.
7%.
Yeah, that is roughly a $200 billion injection into the economy just by getting out of our own way.
And what does that do for commercial real estate?
It breaks the logjam completely. Skilled workers finally move to where they are most needed. The cap rates in Toronto and Vancouver compress because that growth risk premium disappears. It's the fully unlocked scenario.
Okay, that sounds great, but what's the bear case?
Stagnation. The reforms stall out in committees. The provinces keep fighting over whose nursing credential is better. Housing supply fails to catch up with population growth.
So what happens to the companies trying to do business?
They leave, or they decentralize. We would see a dispersion outcome. Businesses just stop trying to grow their footprint in Toronto or Vancouver, and they move operations to Tier 2 or Tier 3 cities, Calgary, Edmonton, Halifax. Or they just go fully remote and hire people outside the country entirely.
So Toronto slowly loses its status as a global growth hub.
It becomes a status city rather than a growth city. It remains expensive and beautiful, but economically stagnant.
Now, there's a third scenario in the paper, the external shock. And honestly, this is the one that really stood out to me because it has absolutely nothing to do with what we build or don't build domestically.
Right. This is the USMCA 2.0 scenario. We have the mandatory review of the North American Trade Agreement coming up. The paper models the impact of a potential trade crisis or a flat tariff situation.
They specifically mention a 15% flat tariff figure.
Right. If the U.S. administration decides to slap a 15% tariff on Canadian goods, the entire conversation we are having changes instantly. We start talking about affordability, and we start talking about solvency.
That is a chilling distinction to make.
But it's the mathematical reality. The projection here is stark. We are looking at potential job losses of over 119,000 in Ontario alone by the end of 2026, specifically in export-dependent sectors. That's manufacturing, automotive, logistics.
So if you're a landlord renting warehouse space to those companies,
your tenant isn't complaining about high rent anymore. They are going out of business and handing you the keys. It triggers a massive flight to quality. Investors would dump anything with risk and pile into only the safest assets. It would likely cause severe, immediate distress in the industrial and office markets that rely on cross-border trade.
it really highlights how fragile the whole system is. We're sitting here worried about the cost of a townhouse, but a trade shock could literally knock the legs out from under the economy before we even get a chance to fix the housing.
That's exactly why you can't just look at domestic policy in a vacuum. If you're a corporate strategist or an investor, you have to be watching the U.S. trade representatives just as closely as you watch your local zoning board.
So bringing this all down to the ground level for the people listening, we have investors, executive recruiters, real estate strategists tuning in. Based strictly on the analysis in this white paper, who are the winners and losers in this 2027 landscape?
You have to be incredibly selective. Let's start with the winner, Class A plus experience office space.
We hear this phrase a lot, the flight to quality.
But specifically, the paper means collaboration hubs that are immediately adjacent to transit. Even with hybrid work seemingly permanently settled at 50 to 60%, companies will still pay top dollar for physical space that actually makes their employees want to leave their house.
Okay, so what's the loser on the office side?
Commodity office. Your standard Class B and C buildings.
The classic beige cubicle farms.
Exactly. If that building is more than a 10-minute walk from a subway station or a commuter train, it's facing structural obsolescence, it is a massive stranding risk. You might honestly never lease that space up again to a good tenant.
What about the industrial sector? You mentioned the power constraint earlier.
Industrial is generally still a winner, but with a major caveat. The winning strategy right now is moving to secondary markets. We are seeing major firms move operations to the prairies, places where the land is cheaper, yes, but crucially, where their warehouse workers can actually afford to buy a home.
Even if that means they are further away from their final customers.
Yes, they are willingly trading higher transportation costs for lower labor turnover.
That is a fascinating trade-off. Basically saying, I will pay more diesel fuel to truck my goods if it means I can actually find reliable people to load the trucks in the first place.
Exactly. It all comes back to the humans. And finally, let's look at retail. The clear winner is grocery-anchored necessity retail.
Because no matter what, people still got to eat.
And because if housing costs are eating up 50% of a consumer's disposable income, nobody is buying discretionary luxury goods.
Yeah.
The wallet share just isn't there anymore. So high-end retail in unaffordable markets is actually a very risky play going forward.
It seems like the overarching theme here, the big leap for you listening right now, is a total mindset shift. For years, the real estate strategy was always buy where the demographic growth is. Now the strategy is buy where the structural capacity is.
That's it exactly. You have to follow the constraints. You aren't really betting on the physical asset anymore. You're betting on the infrastructure grid and the local labor pool that supports that asset.
So, to summarize what we've covered, the affordability ceiling is essentially the new interest rate. We've looked at the exit fee that financially traps talent in place and breaks the labor market. We've seen the pricing paradox, where global investors are already discounting Canadian real estate despite rate cuts.
And we've seen that without fixing the hard physical cap of power grids and transit lines, none of the other policy fixes actually matter.
I want to leave everyone with a final thought today, a bit of a challenge based on this research. If you are sitting in a boardroom right now, planning your capital allocation for 2027, you have to ask yourself this. Are you betting your company's future on central bank interest rates falling? Or are you betting on the government actually fixing the power grid and labor mobility laws?
Because only one of those things actually unlocks real economic growth. You can have the bank cut rates to zero tomorrow morning, but if you can't plug in your new server farm and your new VP of engineering can't find a family home for under $1 million, you have zero growth.
It is a very sobering reality check. I want to say a huge thank you to the source material for this deep dive. Again, that's the white paper titled Housing Affordability as the Defining Constraint on Canadian Commercial Real Estate Development.
It's a dense read, but it is incredibly valuable for anyone in the space. And again, the author is Forbes Rutherford of Rutherford International.
If this intersection of talent strategy and real estate development piqued your interest today, you should definitely look them up. We'd highly encourage you to check out their Constructive Thinking newsletter. You can find that on LinkedIn or x.com. It's a great resource for staying on top of these massive structural shifts.
Absolutely. It's exactly the kind of analysis that stops you from making the obvious but completely wrong bet.
Thanks for joining us for this deep dive. We'll catch you on the next one.
Take care.